Hey traders, this is Ron Haydat Financial. Hope you guys are having an awesome weekend. This is the market outlook for the week ahead. The U.S. market has not opened yet. It's almost 6 o'clock here on Sunday evening. Now, before we get a kickoff, as always, everything in this presentation is for educational purposes only, not advice to buy or sell, and everything is always in a virtual paper trading account. All right, we're going to go top down on the major indexes and talk about what to watch for this week. And we're going to do and start with the strongest. So what I have on my screen right now, as usual, it's a one-year daily chart where each candlestick represents one day in the market. This is the S&P mid caps. MDY is the ticker, and we're using thinkorswim. So this is where we were a year ago. Then the tariffs fell, and this is where we are now. And over here, we were below major moving averages. Here, we're above them. Just to recap, red is 20-day EMA. That's just a short-term trending line. That's all we pay attention to, just very, very short-term. The big ones we want to stay above: 50-day SMA, 100-day SMA, 200-day SMA. So 50, 100, 200. We're above all those. I was reading some articles or newsletters. Somebody was talking about how it's setting up just like last year. And I'm thinking, I don't know what charts they're looking at, but remember, fear sells. But as of now, I can't predict the future. I don't think anybody can. We could roll over this week. We could drop hard like a rock. But right now, the higher risk indexes like MDY and IWM we're going to look at in a moment, they're above all these moving averages. We are not in the same position year over year as we were back in tariffs. Tariffs was a one-off thing, which then brings into the Supreme Court's ruling that tariffs are invalid, etc. There's other ways that these tariffs can be kept. And without needing congressional approval, I'm not getting into the politics of it. I'm already seeing articles written out that, oh, look at the backlash, the refunds, all this stuff. There's other things that can be done, and this is going to be more of a longer battle, which is my 2 cents. But without getting into the politics of it, I want to ask you, does the market care? And when you see these charts, does the market seem to care? No, I think it's been priced in already. Therefore, if the markets don't care from a trading perspective, then neither do I. I may have personal feelings on it, positive or negative, but it's irrelevant. When it comes to trading, the trend here is up. We start cracking moving averages regardless of the index we look at. That's when we become more defensive. We can become hedged. We can take, for example, how I would teach it, take stuff off, just reduce risk, go into more cash, or we can do bearish trades. We can do all sorts of things. But as that happens, don't worry. I will do a video for you, and we'll take sort of like a thermometer, a test of the market at that moment in time. Just please be aware. I have no fear to sell you that they're going to use everything from the potential Iranian war, which is now out there. Again, does the market care? No. Until the market does care, the trend is your friend until it's not. And what stocks do during bull market runs is they continue to climb the wall of worry. All right, so that's MDY. Let's go Indigo Whiskey Mike, which I do have a bullish position in. So this is the Russell 2000. The small caps, are they above the 50, the 100, and the 200? Well, they sure are. Okay, this move up here and then going sideways, this still constitutes a bull flag. There's nothing wrong with this yet. Again, this can all change in one day. We get a big down day. And at that point, right now I'm doing updates on Sundays and typically on Wednesdays. If something massive happens, I'll do another video. But right now we're looking just fine here on the Russell. If we go to the diamonds, which is the Dow, it got near its 50-day in orange. Let's go ahead and zoom in. But we're still above it, and we closed back above even the red line, the short-term trend line, the 20-day EMA. This is still bullish. So we have the mid-caps, the Russell, and the Dow all doing well. Let's go to the SPY, which is also heavy in tech. How is it looking? If we zoom in, we did breach the 100 here and here on 213 and then 217. That was Friday and Tuesday. Monday, the markets were closed. Wednesday, Thursday, Friday, we're back above even the 50. So as long as this line holds, even on the S&P, we're fine. Now, normally we would say the S&P is the big one. We always want to pay attention to it. Typically, that's true, but it is so heavily weighted in tech that software stocks, for example, AI stocks are dragging it down a little bit. But the fact that overall it's holding up is still a bullish sign. It's still a good sign for the bulls. How about the Qs? Let's go into tech land. Again, daily chart. Let's zoom in. Here's Friday, Thursday, Wednesday, here was Tuesday. We penetrated these lows. And when you get those little penetrations trying to flush stuff out, you want to pay close attention because it looks like it's going to come down here to the 200-day SMA in yellow. Sideways, sideways, Friday, zoom into the weekend. They weren't worried about war. They weren't worried about anything else. Not the Supreme Court, nothing. Closed the highs of the day. However, we're still below the 50 in orange, the 100 in white. We're still drifting lower here. This would be considered bearish on the daily charts, and this would be the flagpole, and then sideways, the bear flag. So this would still be a bear flag pattern, but it's the only one of the major 5 indexes that's doing it, and it's all because of, if we go IGV. Here's a gap. I keep saying, you guys, I think we need another big one. This is completely bear flagging out. This is really pretty from a textbook example for a bear flag. If we break these lows, I'm going to say someone is defending here at 80. Let's just look at the volume coming in. Once we hit this, even on the sell-off, we hit capitulation-like volume. Let's just zoom in. These big red bars, it doesn't really matter what the number is. What was it on February 4th? 45 million. You can see the volume, by the way, right here. And then you come over here, 45 million again. That's crescendo, throw the baby out with the bathwater type stuff. Then you have big volume, but you're not getting any consistent move. Then there's more selling. Then there's more selling. You are coming off the lows, so that is people buying. But look, you're just drifting, drifting, drifting. This thing looks like it wants to break down. And if it does, I think, close below 80, it's not going to be pretty. And then if we go, let's look at a 3-year weekly chart. Oh, wow, look at the weekly. We're right on that 200 period on the weekly. It's really being defended, which just goes to my point. If we break below 80, now you're going to come back down to 2023, the pivot in October before the market rallied hard into 2024. That's 65. Maybe that's where we have to go. A lot of talk about AI killing the software stocks, so it may be. But there's no signs right now of a bottom. Even on the weekly candles, this is not bottoming type stuff. This is pausing, fingers on the ledge, barely hanging on by your fingernails type stuff, which usually doesn't bode well. Now, so that's really bad. But look what's really great. Right now during this market, and if you want to write this down, I probably mentioned it before, you want to keep an eye on what the semis are doing. Not all the time, but if we are roaring and the bulls are around, or you want to see if there's weakness in the market, are there any outperformance, you go to the semis. The semis should be leading. When the market is going higher, they should be roaring higher and leading the charge. If the market is weak, it's okay if they led the charge on a down day. But then they should bottom first before the others because they led, and then bounce harder up. And what we've been seeing is when we did have that pullback back here in early February, they led the charge. Even when we're having down days, we're holding the 20-day EMA, which is your short-term trending moving average. They can't even stay below it. Now you're sitting up here. This is like a little mini bull flag. This looks very, very strong. If we crack, you might want to set alerts on this. What do we got? Well, it says the high is 420.60. Make it like 421. We get to there. I mean, unless we're going to have something coming out of left field and torpedo this market, if the semis break this market, in my humble opinion, based just on trading for 20 plus years, it's going to explode. It's going to climb the wall of worry, and it's going to shock the crap out of people because they're going to say, but, and they're not paying attention to what's right in front of their eyes. Us as retail traders, we can't move markets on liquid stocks, so we may have fearful ideas, fearful thoughts, and say, hey, this doesn't make sense. But then you always have to go back to, it's a giant rigged casino. just so you know what we're all playing with here. So when you understand that, you're like, oh, well, what's the big money doing? It's like, they're taking the highest risk assets, MDY, IWM, semiconductors, and they got them near all-time highs. So what would I look for on a down move? We would see an increase in volume. We would see it close the lows of the day. They take down mid caps, small caps, and the Russell. If they tank them all, that would be a bad sign. Now, let's go take a peek at some other stuff. How about transports? Oh, you mean they're almost back at all time at those highs? I forget what we looked at before. I only follow transports from I was going to say from a trending perspective in relation to what the market's actually doing. Yeah, so they're basically at all-time highs again. Powerful move on Friday on the transports. Banks, definitely underperforming. They cannot get back above the 200-day moving average in yellow. What was once support here is now resistance. The old market, if the banks aren't coming along, we got probs. The banks have been trending lower since the beginning of the year, and the semis have gone higher. They are net higher from the beginning of the year. Market doesn't care right now about the banks. So you just want to know that, hey, they're not doing so well. This goes back to what I've said back into the last quarter of this past year. We're going to start to see sector rotation. The AI stocks outside of software, they're not getting killed. They're just base building at these, if you look at a weekly basis, all-time high periods. This is still really bullish for the stocks like NVDA. So the money's going into what? Maybe semis, going into transports, going into staples, some other things, going into small caps, mid caps. That's why they're holding up. This is still okay, that kind of rotation. Again, I'm going to circle back and say for the third time probably, when they break down, then we care. That's when I would consider from an educational perspective, and I would say now we got to lock stuff up. Think of collar trades, think of married puts, think of just taking capital off the table. We're just not there yet. And I say yet and I mean it. So far we're just not there. All right, we did IYT, XLF, we did XHB, the home building ETF. How are they doing? Higher low, higher low, higher low, and you're hanging up here. Home builders are bullish on the daily chart. How about utilities? XLU. The 200-day held all but January 7th, and it's just zooming right up. You almost have a cup and handle starting to form here. I was reading something about, I forget where it was, about the utilities doing well. This isn't normal. Or if you go to XLP, which are the staples, they're doing so well. This is not normal. I agree, but doesn't mean it can't happen. Are the staples overbought? Absolutely, but they're now giving back some of that overbought. This is a huge move. So far, the other risk on indexes, MDY, IWN, SMH are fine. If they were rolling over and these guys were doing this, my words to you would be, it looks like folks are getting defensive. Now, we could say they're getting defensive because they're already running these things up, but maybe they just wanted to pull it out of software stocks and went and bought these. Because when you look at this rally from the beginning of January, and then you go IGV, what happened at the beginning of January? The bottom fell out of software stocks. So you have these people, we don't know who they are, but follow my quote guess or follow my theory. So IGV drops like a rock while staples and utilities go up. And energy. Let's go XLE. Why not? And energy gets shot out of a cannon. You tell me, is that sector rotation? Is that them saying, you know what, we're out of these software stocks. We don't really want to buy AI. They go buy XLE, XLP, XLU stocks. Totally what happened. Now, if the software stocks begin to bottom and catch a bid, then I'm going to guess, because that's the move that happened, they're going to come back down and software stocks go back up. It's okay if money's moving and it's running from one area to the other. It's if it becomes a mass exodus from all the majors and the higher risk indexes. That's the big deal. But that's what I'll cover here for you guys. We'll stay on top of it. No worries. How about MAGs? Let's go. I have a lot of stocks written down here, ETFs. MAGs, right now they're holding the 200-day, MAGS. If they fall below the 200, I would say that's really bad news for the market, but you tell me, do you think the market cares? Nope. These other indexes just pushing right back up to the highs. So if you're trading MAGs, you want to be aware of this. You do not want to see it close below the 200-day. Right now you have a high here, a high here, lower high, lower high, lower high. Low, equal low, lower low, lower low. You still have lower highs, lower lows net. This thing is still bearish, plus it's below all its moving averages. Now, I think what this week is about, you don't like to say it's just one stock, but it sort of is. Here's NVIDIA. These guys are going to have earnings, 2:25, which is Monday, Tuesday, Wednesday, AMC after market close. If they have bad things to say, or it just could be not good enough things to say, this could cap the market. I would expect to see the semis down 5+%, the semis being SMH. I would expect to see mid caps, small caps getting crushed as well, 5+%. We're going to see a big red day in the market maybe. But despite all of this sideways movement and the AI getting a lot of negative press, CapEx getting negative press, all this stuff, it's base building at all-time highs. Are you kidding me? This is actually really, really bullish, because if this is the base building at all-time highs now for 7-8 months, and then you have the report that launches it, now the next leg begins. And it's going to have all these people saying, I can't believe this is happening. This is so stupid. And what I've learned is, because when I got into the markets back in 2000, I started from scratch. I didn't know anything. And I would watch CNBC at the time. Now it's more like CNBS. And I would listen to these people and think they were helping. And it turns out it's just people, just hot air bags, talking. And wait, so the market can climb the wall of worry? I didn't know that was a thing. It's like, yeah, it actually is a thing. And then you learn these things along the way. So I would caution you listening too much to news, because sometimes it plays tricks on our brains and says, yeah, those are all really good points. And they are. But what's the big money doing? And the big money is, right now, we're holding tight on NVDA. And we just have to see which way it goes. Again, I'm going to say it for like the 8th time. High risk indexes are still doing well. Therefore, I remain bullish. I'm not big into trying to time the market. It's really, really hard. So I prefer to just say, well, let's just see what the market wants to do. Now, if NVIDIA really comes out with a stinker of a report, or it's perceived to be a stinker of a report, the market could get clubbed very, very badly. But then we're going to know what's going to be going on here. I mean, if you think back to the last earnings report back here, middle of November, if I zoom in here, NVIDIA actually went from the previous day before earnings, it closed at 187. We went all the way up to 196, closed down at 181. Big reversal. And I remember seeing some of the headlines. Oh, that's it. AI stocks are going to crash. How'd that work out for them? Because MDY, IWM, SMH, all higher from the beginning of the year. And NVIDIA is actually at the same price, near the same price it was during that earnings report. So much for all that negative news. So really, really, really curious to see how NVIDIA is going to be traded post-earnings. Just quickly here, just looking at some of the others. Microsoft, the worry is AI stocks, software stocks. Is AI going to kill it? And it's now come down. We talked about this, filled the gap. There's another gap down here at 366. The way this looks, it wants to go down one more time. Similar to the software stock ETF IGV, I would like to see another gap here. I mean, another big gap. It could get us down here, right? Somewhere down near these lows. Do I think Microsoft is basically a dead duck these days? I don't think it is, but clearly there's some big money that does, because they've been selling this thing. How about Amazon? It's doing a nice U-turn pattern here. It's sort of like jagged, more like a V, but you are now reversing higher. I would say this, if you can close above this like 213 area, then you go gap fill to about 220. Then you're going to hit the 200-day, which will be a thing because it stopped it here, and it's just a huge moving average. Then you only have, like $5 before you have the 50 and the 100-day converging, creating confluence as resistance. But I would say for an aggressive trading idea, not even looking at seasonality, bull put somewhere down here. But I would just be careful for new positions ahead of NVIDIA's report. I'd rather let NVIDIA come out, do their thing, see how the market's going to react, and then go after new positions. Because I think, I can't guarantee this, of course, but once they decide how they want to trade NVIDIA AI in the market, and then when we get this push, it's not all going to be done in a day. We're going to have a trend, which, let me show you this. Here is a seasonality chart at financial.com of the S&P 500. We have 33 years of data on it. We scroll down here, and this dotted line is the future track record. It's the future projection, the future projection of what the stock has done during its 33 years of history being publicly traded. Now, if I take my mouse and I just zoom in a little bit, now you can see, this is what I showed you last week. Historically, this drop is, we're talking at this point, it's 0.7%. There is a dip for the first 2 weeks of March, and then we just go on a run right into May and June. The market enters a very, very strong period. And then if you look at SMH, 25 years of data, we zoom in, same thing, a little bit of dip into the middle of March, and then it too goes from -1 to +5 by the time basically they run till Memorial Day in the U.S. The end of May, beginning of June. All these things historically then have nice up moves. So this is the window if we're gonna get the drop, whether it's geopolitically caused or other. And nothing says we have to. Remember, if I look out just a couple weeks, a lousy 1% drop on the SMH or zero point 0.7 on the spiders, some years that goes up. This is not like it's a massive. And then if you read down here, let me just show you this. I'll come down here and highlight it. Come on, mouse. Oops. Scoot down. The fall is 1.29% over the next 3 weeks. I mean, the stocks rise 48% of the time. So 48% of the time, the SMH goes higher. 51% of the time, it goes lower. This is like red or black at the roulette table. Flip a coin, and there's no huge winner. It's a lousy 1% drop. So I would say to you, some years, we just blow right through this period. And maybe that's what's going to happen this year. I think NVDA will be our catalyst. That's how I look at it, barring geopolitical or anything else, hitting us. All right, so that's Amazon. Let's do Meta. Here is faceplant, Facebook, low, higher low, higher low, high, lower high, lower high, lower high. You have a big old pennant. This one I think right now is tough to trade. You got moving averages in here. If I wanted to throw in a bull put or something, I got to be below swing lows. You look at Apple, it broke out, came back up, and now you're down and you can't get above moving averages. Also like a pennant formation here. Draw a line from here to here, lower highs, from here to here, higher lows. Again, could NVIDIA be the breakout? Could NVIDIA cause the whole market to move? It's very possible. Palantir, you cross the 200, you could not stay above it. This thing is bearish. This is still a bear flag. It's probably going to go with what NVIDIA does. All right, what else? Oh, and I want to talk about USO. I had a question on USO and oil and what I think could happen, and I just want to say my guess is going to be as good as anybody's. Last time we had, there was an attack with Iran, the bombing of the nuclear facilities. Oil didn't really go too bonkers. It normalized pretty quickly. I don't know what's going to happen. I would say if oil's really worried about it, it would be surging and soaring. You can see since January, and USO isn't totally oil, but it's just a proxy, something to follow it. We're up, oil's up, but if that was the case, gold would be going nuts. These things aren't yet. So if they're not yet, and then this passes, maybe these things actually pull back. Or if there's a truce in Ukraine, which it just doesn't seem there's going to be. I get questions on it, and I just say, well, depending which leader in Europe you listen to, they want more war. They can't get people down to the negotiating table to make a deal. It doesn't seem that they want this resolution. And we could get into the specifics and say, well, that's because I don't want to get into that. I'm just saying what's out there. They're not getting anywhere. But gold and silver respond to war as well. If they can somehow get back to the table and they make a deal, then typically you would see gold and silver come down. The difference this time around is, can they actually deliver? Can the COMEX, can London, can they deliver on contracts? Can they not? Is true price discovery finally happening after decades of manipulation? And depending who you read in the gold and silver, the metals, precious metal circles, they seem to think this. But they thought that back in 2011 too. The gold bugs and the gold bulls you got to be careful with, because they're always wanting it to be now. I would say, my opinion is we are closer to that day than we've ever been. And right now, the way gold is looking, this thing is perking up. It's starting to roll up. And what happened on Friday, that close at the highs of the day, that close got us to 468.62. The close here was 467. Since we had the collapse, we have a new closing high. That technically is a breakout, and volume did pick up a little bit. If you go to silver overshot, was doing better than gold to the upside. So it's lagging. It went down harder to the downside, which is to be expected, but it's lagging. It's not back up there yet. But look what it did on Friday. For what it's worth, has not been above its red line at 20-day EMA since we crossed down through it on January 30th. Now you just popped up through it. That is a bit of a bullish breakout. If I were to draw trend lines here, they've all been broken. So it looks like silver's starting to perk up. And then I go to the miners. When I get time in between having a 5-year-old, there's not a whole lot of time. I'll read some articles sometimes late at night. And I was reading one, and it talked about how the miners, they were talking to some mines, the what am I trying to say, like CEOs, executive level people at the mines, and there are still mines out there, miners that don't think these prices are real. And I'm thinking, well, these are the people in the mine. That sounds bizarre to me. And I think there's a lot of that in the stock market where people traders, they don't believe precious metals are going to stay at these prices. And once they come around to that realization, which is what I believe, that yes, I don't think we're going back to $20, $30 silver, $40 silver for, I don't want to say ever, you can never say ever, but no time soon. They're going to stay up here. And at that point, when the miners get revalued and they say, wow, what if the prices stay at these levels? These miners would explode. Because from what I've been reading on the retail side, meaning if you and I are retail traders, the exposure of mining stocks in the average person's portfolio as a retail trader, even many funds, it's just non-existent yet. So this thing is still very, very early if you believe prices can stay at these levels, which I do. So I'm trading some miners myself. But here on SIL, the silver miner, you're into the gap. Gap is filled. It's actually good volume on Friday, all things considered. It looks like they want to turn. If you do GDX, same thing. It's turning higher. You look at some individual miners like RGLD or Newmont or Pan American Silver in the silver market. That was a huge move on Friday. A lot of volume came in. As a lot of volume came in, look how the 50-day was defended here. But again, if we get truce with war, then these things you would assume they would start dropping. If they don't, holy mackerel, would that be bullish? Now they're blowing off geopolitical truces. Then you would the geopolitical war to truce scenario where the miners would come down. If that is removed from the equation, and now you say, wait, so let's just pretend that Ukraine became a truce, Iran thing goes away, everybody's giving hugs again, and these things keep going, then it's more of a worrying about missing out. They don't think the price is going to come down. It's being added to portfolios. Now you have the whole non-geopolitical side, which is super bullish if that's going to be the case. I'll be really curious to see if these things do pull back, if geopolitical stuff calms down. It's sort of going to give us some insight into why are they really buying these miners and stuff right now. So it'll be fun to see when that happens. All right, guys, I think, one other thing to watch. Here's HYG. These are high yield bonds. If these things break down from a technical perspective, that will be bad for the markets. So just keep an eye on H is in Hector, Y is in yellow, G is in George. If this thing starts cracking below major moving averages, I have an alert set right now at the 200-day, it's nothing specific. I just moved my mouse and right-clicked and created the alert. I have 80.38. You could make it $80. We close below the 200-day. You can pretty much bet the whole market is also coming down with it. But right now, it's doing just fine too. All right, so that covers everything that I had written down here. We talked about the tariffs. Basically, it's a non-event. The war, the semis. Yeah, we hit all the big ones. And NVDA earnings this week. So with that, hey, if you're here in the Northeast, they keep moving these snow totals like crazy. 1 minute we're getting a foot or two, then we're under a foot. Now we're back to a foot. Hopefully everybody makes it through okay, but it looks like it's going to pack a wallop for part of New Jersey and New York as it comes through. I'm in eastern Pennsylvania, so I'm near Allentown. So happy snow shoveling. You guys have yourselves a great week, and I'll be back with you Wednesday evening. All right, take good care, everybody. Thanks for watching. I hope it helps. We'll see you later.